So this week, we've talked about a few things, but I think one of the central themes is position sizing. That's kind of where we make and lose our money. Everyone likes to focus on what's the safest entry. I would let go of that. There is no safe entry. As soon as you start adding risk, it's on, right? You got the risk. So sitting around and thinking about what's the safest place to add the risk and this and that, I think is a waste of time. You could spend a lot of time thinking about that, but what I would really do is process your feelings around making and losing money, right? Because you have to understand that this is a probabilistic endeavor. It's not a game about being accurate. You might have it in you where that yet you need that for yourself. In my humble opinion, you're going to find trading very difficult, right? Because the markets are never going to behave other than a new puppy, and that's just the way that it's going to be. So they're going to pee all over your floor, as cute as the thing might be. So I would think about how to process your feelings about making and losing money, and how do you feel about accuracy versus expectation. With that, the one thing that you can focus on understanding, and this goes back to I think Wednesday's episode, and a little bit of Tuesday's episode this week, is what is the optimal portfolio heat for you and for your style. Many of you have got into the bad habit of thinking that it's risk on, risk off, and all of that. But if you really started to study that and you looked at your behavior and you followed on with the trades that you were in and where they went after you got out, right, you can better formulate your strategy and understand and kind of come to terms with how to hold risk overnight over the weekend with the appropriate amount of risk to optimize your expected value. That's the goal here, right? It's not to keep taking several, $250 winners day after day. That's not the point. The point is to, if you want to do it the way the pros do it, it's to obviously study yourself, study the markets, and find everything that you can do to keep your gains large and more frequent than your losses, right? So whatever you can do when you look at that equation for expected value, what is it? It's winning percent times the average winner size. That's magnitude. So it's frequency and magnitude on the win side. Subtract from you subtract from the winners the frequency and the magnitude of what you lose when you lose. And there's ways to optimize that, right? There you can look at your winning percent. What can you do to increase that without having it to have to be 90%, right? A small adjustment, even going from 30 to 35% accuracy or 35% to 40% accuracy, can have a big impact. Maybe not over one particular trade, but over hundreds and thousands of trades that have a big impact. Two, the magnitude of the average winner, right? How do you do that? Well, yeah, you hold your winners longer, right? And then what can you do, whether it's using your instincts, whether it's adjusting your stops, what can you do to decrease your losing percentage? If you go back and look at the live stream that we did, one of the tactics that I did when I started out, especially when my account size was very small, was I tried to get my protective stop to break even as soon as possible, because then I could have 20, 25% of my trades, so I'd just get knocked out at break even, which was better than to let them sit and languish and then finally lose, right? Because momentum stalled, and typically your winners start making you money right away. So you can look at using time stops, right? And being able to adjust your protective stop to break even as fast as possible. You see what I'm saying? And then that will that can help you decrease your frequency of losing. And then if you found and this goes hand in hand with holding your winners longer, if you traded smaller, right, you would have less risk overnight over the weekend. So this way you could hold on to your positions longer. And so it all kind of moves together. It's not just about trying to figure out one particular thing. You could look at any four of the components of the equation for expected value and see how to optimize that. To me, that's not done by looking at a chart. It's done by looking at the data, looking at trading history, looking at what you could have done. There's lots of tools out there. You can go figure out what those are. I just use the spreadsheet because it's the cleanest. There are services out there that allow you to upload your data and that can help you, and that's great. They usually come at a premium. I like to do stuff. Everything that I do on this channel doesn't cost you money, so you don't have to, buy yet another subscription to something as you're trying to figure out your way here on this journey. But That to me is a way, if you're struggling and you find that you're in the grind, is stop looking for the perfect chart pattern. Start looking at the data that you do have and start seeing what are the ways that you could possibly increase or decrease any of those components of what goes into calculating expected value. Either how to increase your accuracy, how to increase the size of your average winner, how to decrease, right, the frequency with which you lose, and then how to decrease the size of your average loser. Any of those things, maybe you could do several of them all at once, but it's only going to come from studying your behavior, because you're the one who's pushing the button that says buy and sell. So you have to look at your own behavior, because that's what's generating the results, right? Thanks for being here, folks. Watch these videos this weekend.